and gentlemen, so welcome to the show, Tim Gertz. We're so grateful to have you on with us today to share with the listeners about some of the new tax law changes and the tax code that's coming up for 2023. Tim has been on with us in the past, but as the tax law changes, it's valuable for him to come back on and just keep us in the loop of what's all happening. So Tim, welcome to the show.
Thanks for having me.
Yeah. So if you just want to maybe start, tell us a little bit about your company, what Provision specializes in, and the ideal client that you guys work with.
So we're a proactive tax planning firm. So our focus is on consulting and working with our client base to be proactive and efficient in our tax planning. So our ideal client is someone that's more of an entrepreneurial mindset, someone that is looking to control their own destiny, someone that has the ability to proactively plan for what they're doing this year, 5 years, 10 years, 15 years down the road. Our goal really is to look at a holistic view of a client and what they're doing to make sure that we're making moves that are going to be efficient today and efficient in 5 years, and not just ultimately trying to plan for today and forget about tomorrow, for lack of a better phrase.
Yeah, I mean, this is what changed my life, you guys. I mean, Tim literally changed the direction of my life. You know, I had this snowboarding career, as a lot of you know, and during my snowboarding career, I had this decent income and I was paying a lot in tax. And I remember my tax advisor at the time in Salt Lake City, we would speak once a year and that was it. And then he would tell me what I owed in tax and it was done. And I just remember thinking, this cannot be the way it is. There has to be a better way than this. So as I started reading all these books, I came across Tim's company and flew out to Arizona. And he's like, yeah, we work with you. We help you plan. We actually look at what you're doing and build a plan of how you can behave in different ways to actually reduce your tax bill legally. And I just remember that day in their office thinking, these are my people. This is the language I've been looking for. And that was back in probably, I think, 2010, Tim, or so. And the rest has been history. Yeah. 2012, been 10 years with us. So the moral of what Tim just said is not every CPA is created equal, and keep looking, keep searching until you find somebody that's speaking your language. And I love it because it's very entrepreneurial. So that's good stuff. So just kind of getting right into it, what would you say to the folks that do have a high tax bill year after year and are maybe frustrated by it or don't really know what to do? Is there anything they can do differently, or what would be some advice for them?
So ultimately is start with today. Where are you today? Look at the different buckets of income that you have. Or is it all active income? Is it passive income? Do you have a mix of the both? Is it portfolio? You've got a lot of equities, things of that nature, and really lay down a foundation of, this is my income stream. This is where my income comes from. This is the specific bucket it's in. And then once you've got that, what is your ultimate goal? What are you trying to do? Where are you trying to head? Are you looking to shift careers? Are you looking to get into a different career or do something different? Are you looking to spend the next 5 years accumulating wealth so that you can, walk away from what you're doing? Really looking at what you're doing. And then once you've got that foundation and that vision, then you can start proactively planning, because that's really what you have to do with taxes. It's proactively planning around where you are today and where you're headed, so that you can be as efficient as possible. Everyone talks about, I want to pay no taxes. For me, it's being efficient, make sure that what we're doing today is going to be a return on investment for tomorrow, and not just, ultimately trying to pay zero taxes, not knowing what's going to happen 5 years from now.
Yeah, when you say active versus passive income, equity income, what's the difference between active income and passive income?
So active income would be anything you materially participate in. So, if it's a business, it's something that you are actively involved in. My involvement with Provision, I'm active in Provision. If it is a W-2, you're active in your job. So it's an active, that retirement distributions from an active job are active. Passive are things that you don't materially participate in. So an investment in your syndication, one of your syndications, Dan, would be passive. An investment in someone else's business that you don't materially participate, meaning that you don't spend more than 500 hours a year in it, you don't spend more time than anyone else does doing, that business, you would be passive in that.
Yeah, and based on what Tim's saying here, you guys, if you're not understanding it all, this is where it's very important to bring somebody who can explain this to you in an elementary style communication, so you understand what the tax law is saying. I mean, you don't really know what to do until you understand how the laws and how the rules are written. So a key team member to add to your business and just your life is a great CPA. I mean, I never would have thought that a CPA would be one of my best friends, but now as we do our business, it's so critical. I can't even tell you, we would not be where we are, and we wouldn't be making the decisions we're making if we didn't have a great CPA, kind of a quarterback. And that kind of brings me to my next question is, when is the best time to bring, I guess, a CPA into your business? Let's say we have an entrepreneur listening and they're getting ready to do some real estate investing. Do you have a few deals, or is it right at the beginning, or what's the best time to get involved?
At the beginning. I mean, ultimately for me, it's better to be safe than sorry. So even if it's something that we can work with you on, then great. But if we can't, I definitely would say meet with someone and then have them say, okay, well, you're here. Once you make move X, Y, and Z, come back and see me. At that point, it makes sense to work together. So, it really is important. I mean, for me, being a CPA is being an educator. That's my role. That should be the role of any team member you have, whether it's your attorney, CPA, financial advisor. They should not be, their goal in life should not be to make money off of you, but to educate you so that you can be as profitable as possible, because reciprocally, then, ultimately we are profitable as well. But, my number one goal is to educate my clients, and that should be any team member that you have. And so even if you're just kind of on the fence and going, I don't know, talk to someone. It's better that you talk to someone and have them say, you know what, you're not ready, than to miss out on that opportunity.
Yeah, the other value I got from you guys right out of the gate was you structured the business with an end goal, a 10-year goal in mind. You said, okay, here you are now. Where do you want to be in 10 years? What action items should we start with now? And how should we set the company up now so that you can be heading that direction in 10 years, which was invaluable now looking back, that you didn't have to restructure the company. So that was huge. And then, for a lot of our listeners, they invest and they're looking for investments. What is it about the depreciation? So you get the depreciation. Everyone's heard about depreciation. How is it that when you invest in these deals, you're investing money into real estate? It's a real estate podcast. How is it that you can show these losses to reduce your tax bill legally? What's happening?
It's just, the tax code is a series of incentives, and that's all it is the tax code is incentivizing you to invest, whether it is through capital gains, where you get a preferential tax treatment, or it's through depreciation. And really all depreciation is recouping the cost of the asset that you purchased. The one beauty and the reason that it is such a hot ticket item right now is, number one, the 2017 Tax Act that made bonus depreciation available for used assets, and real estate leverages. So real estate uses other people's money. You're getting a deduction off of the bank financing that's attached to that piece of property. And so that's why it's such a good opportunity, because the government, the IRS, doesn't matter where the money comes from. It only cares that you have ultimately a risk of loss on that money. So if you and I, Dan, were going into a deal and you put all the funding into that deal, and I put all the sweat equity into that deal, syndication, ultimately any of the loss would be for you first, because you're the one that has a risk of loss. You put the capital into the deal. Well, with bank financing, since they have a lien on the property, they don't have risk of loss. The deal goes bad, they get the property in essence. So really the people that have the risk of loss are the people that invest in those deals. And as such, they have the opportunity to take depreciation, or ultimately to recoup the cost of that investment over the useful life of that investment. In the case of bonus depreciation, it's in 1 year.
Gosh. So just so I recap that correctly, when you say that the losses go to the capital invested first. So basically what you're saying, just so I put it in layman's term, is that you got the capital that comes into the deal, then you got the syndicators. If the syndicator wants the loss, they need to put the capital in to take the risk as well. You can't just get the loss by being a general partner.
You can. So there are people do it all the time, but the problem is you don't have basis or you don't have risk of loss. So risk of loss equals basis. You put $1 into a deal, you have $1 of basis. Means if you have $1 loss, you can take $1 loss because you've got $1 of basis. If you put nothing into that deal and you get allocated $1 of loss, well, you have no risk of loss. You didn't put anything into that deal. So yeah, you could be allocated $500 million worth of losses, but they're just going to sit there and you're not going to be able to do anything with them because you have no basis in those losses.
So when you say basis, what does that mean? No basis. What you say you don't put $1 in, you have no basis. What does that mean?
So in tax terms, basis is the after-tax dollars that you put into a deal or your risk of loss in that deal. So when there's two types that you've got what's called tax basis, which really is the money you put into the deal plus debt. And then you've got at-risk basis, which is, okay, what are you at risk of loss? You put $1 of your own money in, you're at risk of $1. If you have a recourse debt, so the bank can come after you for that $1, then you've got $1 of recourse debt. If it's non-recourse debt, so let's just say I borrow money from you, Dan, and you say, you know what, if you can't pay me back, you can't pay me back, who cares? That's what they call non-recourse. That doesn't give you basis. So ultimately, you don't have the ability to take a loss because you're not on the hook for that $1. And so that's really when we talk about basis, it's what do you have, what skin do you have in the game? What do you have the chance of losing? And that's your basis in essence.
Gotcha. So basically what you're saying is if you take a recourse loan, you'll have more losses because there's more risk.
Correct.
Correct or incorrect?
Correct.
Okay. Gotcha. So there you go, ladies and gentlemen. I mean, and this is a podcast you're probably going to need to rewind and take some notes on. This isn't maybe something you're just going to pick up first time listening through. The tax law is complicated. Hire someone great, get someone great in your team. So going into 2023, there's some changes that are being made with the tax code that might affect rental real estate. Can you explain kind of what the tax laws are in 2022 and then what they'll be changing to in 2023 pertaining to investment real estate, like with the solar credits and depreciation moving from the 100% to 80%?
Yeah. So two big things. Number one, bonus depreciation, which it's been around since 2002. It's called a sunset provision. So it has to phase out. That's how they pay for the tax law changes. They either, they use sunset provision. So ultimately, it's scheduled to phase out in 2026. It's going to go down 20% every year. 2023 is the first year that it is dropping down. So in 2022, bonus depreciation is at 100%, which means any short-lived asset you can take and write off immediately in year one. 2023, those same assets, you're only going to be able to write off 80% of them. So you're going to get, if it's $1, you're going to lose 20 cents of a deduction in 2023 over 2022. So it's not dramatic, especially, so there's a lot of nuances and craziness with it. What we don't get to deduct immediately, we get to depreciate over 5 years for short life, 5-year assets. So ultimately, what you're looking at this year, you're going to get 100% write-off. Next year, you're probably going to get somewhere in the ballpark of about 85% write-off. So it's not dramatic. 2024, it drops to 60. That's where it becomes a difference maker.
So what will happen, do you think, to real estate when the tax incentive isn't nearly as strong? Say you got the 100% this year, 80% 2023, 60% 2024, 40% 2025? Will we see the value of real estate, specifically multifamily rental real estate, come down in value because there's less motivation for investors to put their cash in these deals?
To me, it's because real estate, when did this happen? This happens, the craze started happening. Multifamily was right about 2014-ish.
Mhm.
So that was 4 years before bonus depreciation even came into play, for used assets. So do I think it will create a little bit of a slow in demand? Yeah, it will, because the tax incentives aren't there. So people are always looking for tax incentives when they go to invest. But real estate is a strong investment, and it has always been a strong investment. And if you have a good team member who knows the tax law, we're just going to we're going to go back to where we were prior to
Mhm.
2017, and we're going to start using other strategies. So we're going to do deduction stacking, things of that nature. We have other means to get huge benefits that we weren't getting with, bonus depreciation. So it just means that from a syndicator standpoint, or an investor, someone that is buying property, they're just going to start doing different strategies. They're going to start utilizing different strategies. And then you've got other things like the solar credit that, solar credits after 2017 were starting to phase out. So they were 30%, then they went to 26, 22, and started to phase out. Well, the Inflation Reduction Act brought them back up to 30%. And so now you've got that benefit. So a lot of times maybe you're making up some of the benefits because solar is huge. A solar credit. So, I always use the $100,000 array. You go and you put a $100,000 array on a building, you get a $30,000 tax credit. So that's $30,000 tax credit that is used to offset tax. It's not a deduction, it's a credit. And then you get to write off that property. And so ultimately, there is a little bit of a haircut of about 15% that you have to take off of, but that $100,000 array, well, now we get to write off $85,000 of it. So now in 2022, after the tax law changed in August 16th, I think it was, ultimately we could take a $30,000 tax credit and we could deduct 85,000. And if you're in the highest tax credit, that's another like $24,000 worth of credits. So now that $100,000 asset only costs us $46,000 to buy. So that's huge.
Huge. See, this is what happened the other day. I get a text from Tim. Hey, Dan, the tax law changed for solar credit. Start looking into putting solar array systems on your guys' apartments. We can have massive savings. So this is going back to what is the government? What is the incentive? What are they incentivizing the entrepreneurs to do? And now we have probably 5 properties being bid out right now. I mean, I actually was exchanging emails today about different companies analyzing the cost versus savings, and then we'll shoot it over to Tim and say, hey, here's what we're looking at. What are your thoughts based off of what we're putting in? What kind of savings would we get for our investors? So this is the critical piece of having a team member that is very tuned in, obsessed about the tax law. That's not me. I'm not going to go and read the tax law, thousands of pages, and dig in and keep trained up. That's just not where my focus is. But you got to have somebody on your team who is continually focused on making sure they're up to date on what's happening.
Yeah.
That's why we hire smart people on the team. So, okay. So, I think the question that we get a lot from investors is, hey, I'm selling a property and I'm going to have nice return. Do I do a 1031 exchange, or do I chuck it into your guys' business or passive deal? And not to sway investors in any way, but just purely for material of understanding and helping our listeners. What is the best way? Is there a best way, or is it going to vary?
It's going to vary. I mean, 1031s were all the rage prior to 2017. Then they became basically obsolete because you could ultimately you could pick and choose how much you wanted to put into another property, and you wouldn't have to worry about the nuances of a 1031 exchange. So you could say, I want to pay $100,000 in gain. I'm going to hold X back and I'm going to reinvest the rest into Dan's deal or whatever it is, multifamily. Because 1031 is very restrictive. All the money you get has to go back into a deal. It's just got a lot of little nuances to it. Now, coming 2026, if bonus depreciation goes away, 1031 exchanges might make more sense. But in the current market, or I'll rephrase, in the market of 2020, before interest rates started going up, doing a 1031 exchange didn't make a lot of sense because in most cases you were doing 70% loan to value. So that means you're investing 30 cents of every dollar of a property in cash, and you're getting a deduction of about 30 cents for every dollar. And so you were getting a one-to-one deduction. Now, with interest rates going up, long-term fixed rate debt, lower leverage, it is going to be something that you're really going to have to analyze every deal to see, what am I investing in? Am I getting a deal that has 45% leverage and I'm only going to see a, 50% write-off for every dollar I invest? What does that look like? It really does come down to, because if you're doing 1031 exchange on a property that you've held for 3 years and it's only, it's interest only debt, so you've not paid down any of your debt, most of the cash that you're getting is gain. If it's a property you've owned for 30 years and you have no debt on it because you've paid off all the debt, well, then there's going to be a huge gain, but there's going to be a huge capital repayment just simply in the debt that, the debt that was paid off during the life of the investment. So it really comes down to what you're trying to do. And where it was, if this was a year ago, I'd say 1031s make absolutely no sense. In today's day and age, now you're at a tipping point of, it might make sense to start looking at 1031 exchanges, but I think you're still leaning towards reinvesting and just getting bonus depreciation.
Gotcha. Yeah. See, this is the tax environment that's constantly changing. And as you're doing deals and buying deals as an investor, as a general partner, these are the conversations you need to have as you're going to exit deals. You're looking to reinvest capital. I've got a year-end tax planning strategy set up with Tim here, where we're going to look at what happened in 2022. And as the year comes down to an end, what do I need to do so that I'm not caught off guard when my tax bill is due in 2023? And, just making sure you're clear on that and making educated decisions based off of real-time data is a much healthier way to run your business and your personal finances than to, get your taxes done and say, oh my gosh, this is a punch in the gut. So, yeah. So there's been a lot of conversation about the Biden administration hearing of like 87,000 or some huge number of IRS agents being hired to collect some, 600 billion in unpaid taxes or whatever it is. Is that happening? Will that 87,000 agents help solve what they're, out to fix? Or what's your thoughts on that?
So I'm probably one of the few people that, well, not few people, I know a lot of other people, but I'm one of the proponents for it. And the reason I'm a proponent for it is simply because of my experiences with the IRS over the last 10 years. So this 87,000 IRS agents are going to be hired over the next 10 years. So it's not like tomorrow they're hiring 87,000 people. They don't have the means to be able to do that. They don't have the infrastructure. So it's over the next 10 years. But of those 87, it's about 60,000 of them that they're down simply from attrition from people retiring from the IRS. So the IRS of 2010 compared to the IRS of 2020 is about 60,000 short in employees. So what you're seeing, and if you've ever called the IRS, if you've had the mistake of calling the IRS, you can't get a hold of them. You can't get on the phone with them. Dan, you've witnessed it. We had a string where the person that was inputting the extensions didn't realize that it was the date of the postmark, not the date they received it. So they disallowed a couple hundred extensions that we had filed by paper. And so we had to file notice responses to each one of those and basically say, no, here it is. And that's kind of where we are with them. And, and God forbid you ever have to deal with an audit, most of the people that are doing audits now don't have the background and the education. A lot of them were doing something else before they became auditors. They don't have the experience. I had a supervisor at the IRS specifically tell me that the first thing the IRS cut out was education, because they didn't have enough employees or workload to manage what they needed to manage. So the easiest way to get more capacity was to get rid of education. And so now you've got auditors that aren't educated, and they're overwhelmed, underpaid, and uneducated. And so for me, I'm all for it, because you know what? The best experiences I've ever had with the IRS are with individuals that are educated, understand the tax law, and know what they're doing. I literally had an auditor tell me that they don't know tax law and that I should not speak to them about tax law because they just don't understand it. And
That's
so for me, I'm all for it, because you know what? If we can get lag times down, I mean, I have clients that are still waiting for refunds from the CARES Act carrybacks. You know, I have clients that have refunds that are sitting in limbo simply because it's taking so long for them to process them. You know, if we can get to a place where things are more automated, I'm all for it. Now,
yeah.
does that mean that there might be more audits? Potentially, you know, based on the numbers. So true audits, you know, and I ran numbers when this all came out. There were 151 million tax returns, individual tax returns filed in 2019. There were 100,000 audits.
Oh, wow.
So if you run the numbers on that, that's about 0.006% of all returns are being audited. So even if they were to triple that and say audit 300,000, you're still less than 1%. And so your likelihood of being audited is, or well, less than 0.1%, I'm sorry. So your likelihood of being audited is 99 point, or not being audited is 99.9%.
Yeah.
These are pretty decent odds. And you know what? If you are working with someone and you're doing things that are above board and you have your I's dotted and your T's crossed and you have substantiation for what you're doing, it shouldn't matter if you get audited or if you didn't. And truthfully, you want an auditor that's educated, because if you don't, it's just going to cost more money to do that audit.
Yeah, wow. That's some good insight right there, Tim, because when I hear that, just so you know, I'm like, oh my gosh, 87,000 people, what a waste of money. But now I have a better perspective of what's going on. And now I also know, because I remember you firsthand saying, yeah, I'll call the IRS tomorrow. It's going to take 3, 4, 5 hours to get someone on the phone. So you start putting what's really going on together. And the reality is if you're following the tax law and you're doing things correctly, it shouldn't matter how many people are on the thing. And if you do get audited, it shouldn't be a big deal either. The law should be followed accordingly, and it shouldn't be an issue. So I appreciate that answer. And I think a lot of our listeners will appreciate that too, and not feel so much, you know, maybe anxiety hearing that 87,000 is being hired, knowing that they were down 60,000 since 2010. I mean, that's incredible.
Yeah. I'm happy about it. I think it'll be good. I think it'll get us back to, I mean, I always tell the story. We used to pay for a service to be able to get in contact with the IRS. We couldn't get in contact with the IRS, so we paid for a service that would put us in a queue. That service was suspended about a month ago because they couldn't get a hold of the IRS. So they stopped business or ceased operations simply because they couldn't get a hold of the IRS. So, I mean, it's one of those situations where even if it just alleviates that issue, that in turn gives us more time as CPAs to focus on what we need to focus on, proactive planning, and not spin our wheels and spend so much time chasing these notices and, you know, trying to resolve issues that shouldn't have been there in the first place.
Yeah, I mean, that makes total sense. You're spending your time trying to get a hold of a company and educating the IRS on auditors that don't even know what they're doing. I mean, that sounds sketchy for sure. So
Yeah.
with our passive investors here, you know, what are the major tax benefits that they could find or see compared to investing in other investments like a, you know, stock or bond or mutual fund, those types of investments? What are the advantages and disadvantages when it comes to tax on those real estate versus those?
I mean, the nicest thing with passive investing is, in most cases, especially with multifamily, whether or not we have bonus depreciation in play, from a tax perspective, from a paper perspective, real estate's inherently a loser. So you typically do not have taxable income in real estate until you have the year of sale. So, why is it a good investment? It's a hard asset. It's one of the few assets that you can actually leverage. So whether or not you're getting 80% or 50%, you're still using someone else's money to invest in that. And throughout the life of the deal, you're getting cash flow back and you're not paying tax on that cash flow. And then the year when you have a huge income event, the gain, in most cases, that gain is going to be taxed at 20% capital gains rate. So not only are you getting tax-free income throughout the life of the investment, which would, ultimately potentially be taxed at ordinary income rates, but then you're getting a large capital gain at sale and you're recapturing that depreciation if over a long period of time at capital gains rates. So you're getting a deduction in ordinary income rates and you're picking up tax at capital gains rates. So that tax arbitrage is huge as well.
Yeah, it's great answer. Very, very well put. So from your perspective and your experience working with investors as a CPA, what are some of the things that you see that separate a well-run syndication company or firm versus one that is a poorly run company?
So typically when I talk to clients, I tell them, if it's the asset class you're looking for, you are investing in the syndicator. You're not investing in that asset. The same asset under two umbrellas can be completely different based on how they're operating. So what I look at and what I tell people is look at the team, look at the people on their team. Who are they working with? Are they flip-flopping? Are they working with different people every single year? Are they in one geographic region, or are they in 85 geographic regions? And ultimately, what's the goal of the sponsor? Because as a sponsor, you should be fiduciary. You should be looking out for what's the best interest of your investor. And so if you're talking to a syndicator or a sponsor, and everything that comes out of their mouth is I or me or this or that, or, returns for us, they don't really care about their investor. They don't care about fostering that relationship with that investor. Their concern is with themselves and them making money. And so for me, really, it's just, how do you feel about the syndicator? How do you feel about their team? Yes, track record is huge. It's something that you should definitely look into and make sure that they have a good track record. But really, it's who are the syndicators and what are they doing? And what are they going to be able to do for you? And what do they say they're going to be able to do for you, not for themselves?
Yep. Love it. Very well spoken, and a man of a lot of experience, ladies and gentlemen. So I'm telling you, listen to this podcast a few times if needed. The information here is it's gold. I'm telling you, it can save you a lot of headache and a lot of pain. So, kind of to piggyback on that question, I guess, are there any red flags when you're looking at a deal? You're looking at investing passively in a deal, any red flags where you're like, I'm just not going to invest in that deal due to X, Y, or Z?
For me personally, I don't invest in deals that people don't put their own skin in the game. I feel if you're not confident to put your own money in that deal, that means that you're not confident that the deal is going to make money. So that for me is number one. Number two, I also look at how's the deal structured? How's the capital stack? Is there some crazy allocations going on? Are they bringing in preferred returns to try to get the multiples up? What are they doing? And where do you fall in that capital stack? If you're fourth in line and, your limited partner interest is only 8% of the deal, they don't really care about you. They're more focused on the money they can make and the preferred returns they have to get for those investors above you. And so for me, I like looking at where we're headed. What's the capital stack look like? Again, how much skin you've got in the game, and ultimately just getting and fostering a relationship with that syndicator to know what's their goals.
Yep. I love it. Really good information, you guys. So you just touched on one thing there. I just want to go a little deeper in. You said I'd be a little bit cautious when you see preferred returns in order to get multiples up. What do you mean by that? What would make the preferred return make your multiples go up?
So in a lot of situation, what they do is they might get, you look at a deal and a deal's got 50% leverage. And then maybe they've got a preferred return where they bring in 30% on the preferred return. So now they're getting long-term financing, but then the preferred return has a 20% return on investment that is guaranteed to them. But ultimately it's structured or stacked in a way that that capital is treated more as debt than it is capital. So now all the deductions are going to the limited partners that are common partners. And so ultimately they're able to get bank financing at maybe like 5 or 6% or whatever it was, get preferred returns at 15% or whatever it is. And then ultimately the last person on the totem pole is the limited partners. They might get all the deductions because that's the focus now. Everyone talks about bonus depreciation. I'm going to give you all the bonus depreciation you want in the world, and we're going to do this to make it happen. But they never focus on, okay, well, what's the returns and what's the likelihood of getting those returns if something happens? If the market goes stagnant and I've got to pay the bank 6% and I've got to pay my preferred investors 15%, yeah, you're going to get the leftovers, but what is the leftovers? And what's the likelihood after year 10 or year 7 when fixed debt comes up, if the market's still in a bad position, that you're going to be sound in your investment? And so
Yep.
that's what I'm talking about.
That is explained so well, ladies and gentlemen, and exactly why we don't do preferred returns. It's in the pref equity piece, just leveraging these deals up. Tim, I can't tell you how much we appreciate you being on our team. Is there anything that we missed that you'd like to discuss in regards to 2023 that our listeners should be aware of that we didn't touch on?
Not really. I think the biggest thing, especially coming into a close of the year end, is make sure that you are being proactive with the 2 months that we have left in 2022, and make sure that in being proactive, you're not hurting yourself in 2023. So make sure that you're looking at where are you going to be. If in 2023, you think you're going to have some capital events, you're going to have large gains and you've got a ton of cash today, well, if there's deals that you want to invest in and you're holding on to that cash simply because you are afraid of what's coming in 2023, it might be an opportunity to kind of build up a war chest of deductions or passive losses that then could be used in 2023 to offset those gains that you're having. So for me, it's just be proactive. Make sure that you're sitting down and you're actually thinking about today and tomorrow.
Yeah. I love it. I absolutely love it. This is this conversation. It's about tax, but it jacks me up because there's so much of your freedom is dependent on how you behave and what you do, and so much of your life is dependent on this subject here. So Tim, again, thank you so much for coming on. I know our guests appreciate it. You guys listen to this episode again and again. If you need a great CPA, I'm telling you right now, Provision, Tim Gertz, one of the best in the country. He's been a phenomenal team member for us. I don't get paid anything for saying that. I'm just telling you the truth. So Tim, thanks for being on.
Anytime. Thank you.
You bet.